Okay, folks. So I'm on stream today with Neurojack, somebody I met in the panel and YouTube streaming community, and he has interest in what I do with stock research, mainly because he wants, as I understand it, to have a better understanding of how people can make their money work for them, achieve some financial independence and security, and have, as he's put it, like a more diversified source of income and wealth. Maybe he can put it in better terms. Is that about right, Jack?
Sounds good to me.
Okay, yeah. So one of the ways you wanted me to, for our first stream together today, is for me to show you how I do like my own research, at least how I start that process with an individual stock, since the articles I write are about individual securities. And so I'm ready to go ahead and do that right now. I just want to see if there's anything else you wanted to ask or clarify before you give me a specific investment for me to start reviewing.
No, let's dive right in, and trust me, I'm the question guy. I'll have like 100 questions, so I'll let you go a little bit first.
Okay, gotcha. All right, well, let me go ahead and share my screen. I'm going to share. Okay, here we go. This is Seeking Alpha. And so it's this is the platform on which I publish articles. Now, subscribers, of course, can see different things as well. So this is the subscriber point of view. This is the analyst center. But this is very helpful in my research. There are other platforms people can use that has information about public investments. So Seeking Alpha is one, Morningstar is another. There's a lot of subscription services. And I'll just go ahead and show like an example of why it's useful. So I'll just put in a very common stock here. It's Alphabet or Google. Alphabet is the parent company of Google. And so what a lot of these sites do is they have the aggregated financial data that is disclosed to the SEC. This is disclosing financial data to the SEC is a legal requirement for companies that want to be able to trade publicly. So basically have stocks that trade on exchanges. And so they have usually the last decade of full year results. And we see here for Alphabet, it shows revenues here, how they've grown from 69 billion. Well, this is quarterly I have. Let me go to annual. Yeah, I had it on annual. Usually it comes up as annual by default. But yeah, so it goes from, okay, so about 75 billion in 2015 to 350 billion in revenue in 2024. And that's just revenue. You can look at expenses here. They combine some items to aggregate it a bit. So they may be broken down a bit more into their constituent revenue sources or expenses in the actual income statements from those financial reports, so that they can still be valuable to read. But if you just want to go ahead and get like a quick trend of the data, this stuff can be accessed here and imported. This is just the income statement, so you can look at the 10 years of balance sheets, so you can see, assets, liabilities, and it breaks down like how much their cash position grew over time, how much debt they've had. So their long-term debt was about 2 billion 10 years ago. It's a little over 10 billion now, but it's not really a lot when you consider they have usually had around 100 billion in cash. So my guess is that that long-term debt is just a credit revolver that they use to just make a quick move if they have some of their cash tied up in something else. Look at cash flow statements as well. It's all aggregated here. So pretty much any financial metric that you would think is important, you can get a decade's worth on a platform like this, and do your own analysis. And so it kind of depends on the individual stock. In most cases, I'm interested in the cash flow, and that's what you would find here. And generally, you're looking at the cash from operations also known as operating cash flows, and then the capital expenditures. And generally speaking, if you subtract the capital expenditures from the operating cash flows, you get the free cash flow, which is a non-GAAP figure, but is essentially what is considered the true earnings of a business. This is not going to be technically true for every business, but for most, especially non-financials, which Google is not a financial, it's going to be the real earnings. So if we look here, we have about 125 billion. We have about 52 billion in capex. So they're making about, at least as 2024 goes, about 77 billion in cash. If you add acquisitions here, you might consider that's also capex, because basically capex is when you make investments into your own property and equipment. If you acquire another business, you're basically just paying the original owners for the property and equipment they have, but it still gets added to your own on your balance sheet. If it's a business that's regularly doing mergers and acquisitions like Google, maybe you would add that to the capex. Some people are very stingy and say, no, capex is only internal stuff and this shouldn't count, but whatever. Those are people who are usually being academically difficult without really seeing the point that it's about cash flow.
So just I want to make sure I'm looking. So what stock is this looking at again?
This is Alphabet, so Google.
Okay, got it. Okay, so it's 181 a share. So just bear with me for so Seeking Alpha is a software that basically gives you all this data for trades.
Yeah.
Can you actually trade from this software as well, or?
No, you don't trade from here. It's just a research information platform.
It's like a visualization platform, essentially, right?
Yes, and
Okay.
this is where I publish the articles that I write. And
right.
So if we were to go here to the main page, you scroll down here, analysis. Here's one that was published recently by Cody's Dividends. So I guess this Cody person writes about dividend stocks, and this is something they published today, this morning. And this is their thesis.
Right. So your friend wrote this one, that article.
Well, whoever that guy is, yeah.
Right. So let's go back to that main page that you had. So let me ask you a question from just a basic standpoint, because I've looked at stocks before, and so like I'll give you an example. Like I the only thing that I'm currently invested in is like VOO, I think, Vanguard, something Vanguard. And what I did was I just basically looked at a chart like this, and I put it over 5 years, and I said, what stands out on this thing? And I saw where there was a dip, and it looked like there had been a recent dip a few months ago or something. And I was like, okay, when this stock hits 117 or something, send me a notification. I want to buy in when it goes below 117, because it looks like it'll never go below 117 for the foreseeable future. And so that actually happened, and it sent me a thing, and then that's when I bought in, right? And what for you as an experienced person, like what do you look for? Like what's the first thing that you look at? Yeah, there you go. So I think it dropped down to like 517 or something, and then that's when I bought in. And it might have been VTT. It was one. They have two different things, but it's like I think it was VOO though. I think it was this one. I think it was S&P 500 ETF. But So I looked at something like this, and so I think it was. I wish I remembered, but it was. There was a dip, and I think I bought into VOO, but basically I just looked at the chart and I was like, this thing stands out to me. That's when I'll buy in, right? And I think it was a good move on my part for someone who doesn't know anything about this. But for you as an experienced trader, when you look at something, what's the first thing that stands out to you, and then you go from there? Like what's the first metric that you look at, like on that list that you were showing me, or is it a chart, or what do you look for?
Yeah, so when I'm just go back to Google. When I'm looking at a stock, this is not the first thing I look at, whether it's 10-year, 5, 1, 6 months. This is not the first thing I look at.
Okay.
It might end up being the first thing I look at, because it just might be put in front of my face, but it's not because I'm seeking it out generally.
Right.
First thing I look at is last 10 years. I look at revenue growth, and then I usually go from there, and I'll take
By by
the
by
debt.
percentage, you look at the percent.
Yeah, basically a percentage thing. I mean, the actual raw number is important too, because
Okay,
um, if we look at just revenue, for example, oh, wrong one. Yeah, if we look at revenue, um,
got it.
this is good growth. Like percentage wise, this is good growth, but um, not every company can be clearing 100 billion in revenue and continue to have very strong growth.
Right.
Now Google can do that, but it's if I saw this same level of growth, but you move the decimal over 3 places, I'd be more certain about the one with the smaller revenues and their ability to grow, just because there's more opportunity, right? To grow revenue, some of it's value creation. A lot of it is just GDP capture, right? If you have a business and you're growing revenue, you're capturing GDP from other businesses, and there's a small element where your product actually has a new creation of value going on, but most of it is GDP capture, and the GDP capture is happening because you're probably doing something better. But if you go from a $100 million company to $100 billion company, most of that was not you just created 100 billion in new value. Most of it is you capture GDP from someone else, and maybe a margin of that is new
Right.
value you
So
create in the economy.
so for example, I'm sure you know who Alex Hormozy is, right?
That I don't know. No.
Oh, really? Okay. So this is just a guy. He has like $250 million worth of businesses, and he gives general advice to poor people like me who are trying to figure it
Mhm.
out. But he said something that stood out to me. He said, "You don't want to go and knock everybody else out of competition. You want to grow, so you basically capture part of the market, and the market funnels back into you." So is that what you're saying? Basically, it's like you're basically saying that it's not like you don't create 100 billion in value. You're creating uh, like an efficiency that is hard to deny. Is that kind of what you're saying? Something like that?
Yeah, something like that. I mean, essentially, when Google is this large, when we talk about like how big this is, they're very few things that they're just going to be able to scoop up that um, other people weren't doing. So, like, what Google's source of revenue? Well, a major source of it is ads in their search engine, ads on YouTube, things like that.
Yeah, they
Um,
basically have a monopoly on ads to some degree.
right. So, to some extent, a lot of money on ads that would have been spent maybe on radio or TV just got redirected to Google. Right. So they captured that GDP, that
Yeah,
those ads budgets from other businesses.
because they're just more efficient at people seeing a visceral return on investment.
Right.
that
Right.
that is that is that is measurable. So, and I almost think that like the measurability of it is kind of why it captured so much.
Yeah.
Because I know that if you go buy like TV ads and stuff like this, I've heard from people who did those businesses, TV, billboard. It's very difficult to track um, those lead sources, right? Like you're like how many sales do you get from a billboard? Well, there's no metric to see how many eyes were on that billboard and how many people remembered the billboard and then decided to go and buy the product, right? Like, so I think that's so we're just taking so just I'm just trying to keep it on a fundamental level. So you're saying that
Right.
essentially like there's like a little something that they offer that just nobody else could offer, essentially.
So
Not
there's that.
necessarily that they had not necessarily that they created wealth per se. And I'm trying to just understand the difference because you're saying the first thing you do is look at revenues, right?
Hmm.
And so and then what's the secondary thing that would like help you?
Well, I would
Uh,
look at revenues, and then I would look at their cash flow. So I would look here at the operating cash flows and their capital expenditures, and I would mainly try to see that this number minus this number is positive, and it's also tending to grow. So here we saw, in 2015, this was uh, about a 15 billion in free cash flow. If we go to 2019, it had grown to about, looks like 31 billion in free cash flow. and now in 2024, we can see that it's about 77 billion in free cash flow. So, essentially, the free cash flow being the true earnings of the company. It went from about 17 billion to about 77 billion in the span of a decade, right? So
And where are you getting that number from? 77. I don't see that on the thing.
I'm doing the math here. So you subtract this 26.5 billion from about 10 billion, you're getting close to 17 billion, and then do the
Okay,
math
got
here.
it, got it, got it, got it. Okay, sorry.
Yeah.
Yep. Okay.
Actually, no. Just making sure I'm doing the math here right. Actually, this would be more like 73 billion. So quick correction, but essentially, that's about what? About
So
four
it's the
times.
X. It's basically like uh, you're basically looking for liquid assets that aren't tied up into something, essentially, correct?
Um, well, you say aren't tied up into something.
Well, meaning like they have 77 or 73 billion that are basically available that if something goes wrong the next year that they can say, well, we need to apply this to a
Well,
problem.
that's one way of looking at it. But I mean, the reason I look at the cash flow is because that's what a business is worth. The business is only as valuable as its ability to generate cash. And so, if you're going to value a business, if you're going to determine what is a good price here, um, the individual share price isn't so much important as the market cap is. So really, the
And where
price of Google
and where's the market cap at? Where do you
is
find
right
that?
here. It's right here. Um,
Okay,
Most
got it.
stock pages will show it on the side somewhere.
And
And
what does that
so
mean, market? What exactly does that mean? I think I know, but can you just explain what the market cap is?
the market cap is this number, the share price, times the number of shares that currently exist.
Okay, got it. And
So that's
so,
basically the value for the whole company. So this share price, if you wanted to buy out the whole company and make Google private, well, Alphabet private for this share price, so you buy all the shares that everybody else has everywhere. If you did it at this share price, you would spend over $2.2 trillion to do so. That's
okay,
basically
where are you getting 2.2 trillion? Because I don't see. Oh, I see. Okay, got it.
yeah.
2.2 trillion. Okay,
Yes, that's right. It does the math
got
for
it.
you. So
Got it. Got it.
these
Okay.
platforms usually know how many shares are currently outstanding. They'll update when quarterly results come out and show if those have been changed or not. Which often they change a little, either because companies will issue new shares to raise capital, or because issuing shares is part of their, like if they have a stock compensation plan, that's part of it. And then some of them also buy back shares a lot. Which, if we look at the cash flow statement, you could even see that. Like go here, repurchase of common stock. So here, this is an interesting thing to look at as well. In 2015, Google spent 1.7 billion in repurchasing its own shares, and in 2024, it spent over 62 billion in repurchasing its own shares. So almost all of the cash it generates is being used to buy back its shares. Um, so, but yeah, so that would affect like the number of shares over time, right? So if we look down here at how the total common shares outstanding has changed, it's gone from 13.7 billion to 12.2 billion in a decade, and a lot of that has happened more quickly in recent years because the buybacks have stepped up. So, but that's sort of like what will influence the market cap. It's how many shares are there, and then what is the price that the market wants to set for each share, and but that's going to be the price per share is going to be based on what in the long term makes sense as a value for the whole company. So essentially, the market is saying, well, not that they think 181 is a good price for Google because of all this, but because they think this company should be worth 2.2 trillion dollars based
Okay.
on. Hold on, let me.
Based on the total
Based,
market share they have of the whole
yeah,
share of what they do.
well, no, based on its cash generative ability, not market share. If it had 1%, whatever we want to say Google's market is, if they had 1% of that market, that they're making this much money.
Is there a metric for market share, like a percentage of a market, or way to measure that, or?
It depends on what you're saying the market is, right? So if it's an ad market, that's one thing. If you look at Google as occupying multiple markets, you could say it has, and sometimes, companies, for example, like Progressive does multiple forms of insurance, right? So you could look at what their market share of automobile policies are, right? That would not
Right.
tell you what their market share of their homeowners policy is. And so
Right. Right.
both of those are
Got
going
it.
to be part of the total financial results. The ad revenues are certainly a big part of it here, but we know, Google does other things, right? There's Google Pay, for example,
Well,
that's some of it.
right.
And then you're
Well,
comparing them to the fintech at that point.
right. Well, and I guess like ultimately we would assume that the true value of Google is mainly that, they have a lot of products, some of which are paid and some of which aren't. They have YouTube and all this, but really it's the data aggregation and organization. Meaning, for example, they pull from all these different sectors, and so they have a good metric on
Right.
where attention is going, where it's flowing, and
Right. And
potentially,
so they have cloud and AI services now too. So that's going to be part of this. So at some point, do you think of it as like, well, is it a dominant player in its market? Is it this sort of self-sustaining ecosystem that's creating new revenue opportunities? And if so, what kind of growth assumptions do I want to make on the cash
right,
flow?
right,
Because
of course,
the idea here is if you did buy all the shares, this is why it's important. If you buy all the shares, this doesn't matter anymore because this isn't what's happening. This goes away. This up and down and zigzags. So all you're left with, if you were to buy all the shares, is this, right? So if you buy it and then you're just going to run the business for cash, well, this is the cash it can generate.
right.
For you.
Well,
This,
well,
this,
and
this.
right, and so basically, what you're saying is it would be 73 billion a year, which if you try to add that up to 2 trillion, I'm assuming that would take about 20 years to quote unquote get a return on investment. But you're assuming that between here and there, or whatever, I know that's a bunk number, but you get the idea. Like, whatever
Yeah.
whatever the number is, it's not necessarily about the profit; it's about the sustainability of the model in the long term,
Well,
essentially, right?
it is about the profit because if the cash flow went down to 20 billion in a decade, buying it for the whole thing for 2.2 trillion today would be a terrible investment. But if the cash generation doubles, right? If in 5 years it's making 140 million instead of 70 billion, then it's a lot easier for it to reach that 2.2 trillion dollar valuation for you to get your investment back and then continue to pay yourself the earnings of the company. And so
Right.
essentially what I am saying is I look at every business through this same fundamental lens. And so if I were to buy just a single hot dog stand, somebody owns a hot dog stand and they offer to sell it to me, whatever price they offer, it's only going to make sense depending on how much cash that hot dog stand can generate. And let's say if we want to do something that is in the same proportion to Google's valuation, if we go off of 2024, and even we see it's a similar amount with 2023, a little over 70 billion in cash being generated. So let's say there's a hot dog stand that makes $70,000 a year, and I'm offered to buy it for $2.2 million, right? For that to make sense, I have to make the same growth assumptions about that hot dog stand that I do about Alphabet. Because mathematically it's the same. So it'll be the same.
And so that's why you're saying there's diversification is so important because you're basically hedging your bets about
Well,
predicting the future, essentially.
I don't say diversification is important. I know that's an important thing to you. I don't think an investment, if we're talking about like, at first it depends on what you mean by diversification. You could argue that Google itself is a diverse investment because it has so many revenue sources, right? It's the global
Right.
search
You
engine.
got
It
it.
has
Yep.
it has a lot of customers are big businesses, big, medium, and small businesses really that subscribe to their services. At what point do you look at that as a diversified portfolio of revenue sources, right? Some people don't look at individual stocks as diverse, but you could make the argument that they are.
Right.
And
That makes
so,
sense.
right. So it just it depends on what you mean by diversification.
Right. So
Now,
so go ahead, sir.
well, I
Oh
would
no.
say the reason why people like diversification is because the price tends to be less volatile on a day-to-day basis, and that's
Right.
usually what scares people. So it kind of just depends on how much you're bothered by that. If you're not bothered by volatility, so I mean, we see, on September 10th it was 150, and then on February 5th, it was 193. So, that's a pretty big margin of difference right there. And, if you needed to get this money out by this time, then yeah, you better hope you bought here, and then this is when you needed to get out. But if you bought in here and you need to get out here, this could be a bad thing. So people like diversification because a diverse portfolio of stocks usually doesn't have as much volatility within a single year, because the price fluctuations of the holdings tend to balance each other out. That's why, like the S&P 500, which is what VOO is. This is just the S&P 500. It's just a Vanguard ETF that invests in the S&P 500.
Right. So do me a favor, hit the 5. Yeah, perfect. So let's take a look at this for 1 second. So like, I see that it dropped in 2020 for obvious reasons. We know why.
Mhm. Yeah.
And that was what was that number right there at the bottom on that little bottom?
It's about 200. Yeah, almost 200.
All right, so 200, and now we're at 550-ish. It looks like.
Mhm.
So definitely, if you were to set a reminder for yourself, let's say that you bought in right in the middle around 300. Let's just say approximately. Let's say that you bought in around, or no, I'm sorry, 350. Let's say you bought at 350 right there in the middle, right?
Uh-huh.
So like, if I were to set an alert for myself, I would say, well, if it goes below 350, obviously I want to sell because I don't want to lose money. Or so you'd probably set it somewhere between 500 and 350, right? But then you also might send yourself a reminder that if it goes below 350, that you'd want to buy on the long term. You know what I'm saying? Like I look at it like this. Like I don't know much about trading, but I would say that like setting alerts for yourself seem important on both things that you're invested in and also that you might want to invest in, right? So like on this trend, obviously you don't want to go back down to 220 if there's another quote unquote event. And there's no way to predict that, obviously, right? Per se, but if you had alerts or I don't know if they have like auto trades that you say sell before it gets to this number, right?
Well, I don't usually look at anything like that at all. Like I don't worry about, if it goes back down, I need to worry about this, because it really just matters if you're looking at an individual business. Where it was previously really is not going to inform when you get in or out. I mean, if we look at where Google was during the bull market of 2021, so this is a bunch of memesters using their COVID stimulus checks and such. I mean, you got up here. This seems like a crazy valuation, and if you look at this, you think, oh, I was an idiot for buying. But if you just held through it and waited for it to bounce back up, suddenly you feel like you're smart. And the question is, why did it even pass the bull market highs? And the reason is because Google, as a cash generative asset, continued to show better and better results. So even when there's a war in Ukraine, and we see its operating cash flows did not decline. Technically, free cash flow is lower because they spent more on capital expenditures, but cash flow growth has continued. There are a lot of businesses where once war in Ukraine happens in 2022 and interest rates start being hiked throughout 2022 and 2023 and into 2024, these numbers are lower than where it was at the peak of 2021. That was not the case for Google because there's something about the way Google operates in which its value is enhanced. So it went from, making about 30 to 40 billion a year to making 70 billion a year, even when there are things challenging the economy. And
Right.
So that's why it goes up. So it's really understanding what is the value of a business and then what is a reasonable price for it. And old prices reflect, what were the fundamental realities of a business at that time. And you may never get that same entry price again, because if the business is
Right.
growing and continuing to do well, it has no reason to go back down there. What did cause, a lot of companies to go down, I should do the 10-year because COVID's been a while now. What did cause a lot of companies to go down, was the fact that COVID just created a sell-off. And in the moment, if a lot of people say, "Oh, I don't know what's happening, let me just sell everything to get cash," they're not looking at the long-term value. They're just making sure they have liquidity so they can buy groceries or whatever.
Right. Right.
All right. So you look here, whether you bought it right at the peak before COVID or after a crash when it went from 73 to 53, if you didn't sell here and it went down here, you might have felt like an idiot. But if you bought with your life savings here and you just stomached through it and held all the way here, do you feel like an idiot? No.
No. No.
And the
Definitely
reality
not.
is, if you had the guts to do that, you probably looked at what Google was capable of doing as a cash generating asset and just knew that COVID was unlikely to hurt them too much. And when you think about it, it's a search engine with some other things added to it like YouTube and such. How much was a pandemic really going to screw up Google's revenue opportunities? Probably not at all. And
Yeah.
so there's really
Obviously, it only helped ultimately. So.
yeah, and that's why you can see basically the stock price had pretty much recovered by the summer, which most stocks did not fully recover by the summer in 2020.
And so that gives you a good indication of they're kind of prepared to weather unpredictable storms coming
Yeah,
up.
yeah. And what would probably happen is, the next quarterly earnings came out, conference call with analysts happened, and basically management told them, yeah, we're not affected by this. This really hasn't been a problem. And then people are like, oh, okay, all right, better buy Google because clearly they're not about to go out of business, where, some businesses did. So if you look at, I'm trying to find an example of something that was really hurt by the pandemic and hasn't quite bounced back. Trying to think. Well, maybe not the pandemic, but let's just look at U.S. Steel. So look at them. And you look here, you see them. They started to do well, but they had problems after the war in Ukraine started. They got bought up a bit, but then they went down a bit. And if we look at where they were really impacted, look at their gross profit. So this is their cost of revenue. It really increases as inflation happens, and they're not really able to get it down because they have to import iron. They don't create their own iron supply. Two of the biggest exporters of iron are Ukraine and Russia, and that trade route got screwed up when Russia invaded. Right, so we see that their gross profit gets squeezed and never quite recovers, and iron and ore prices are still challenged, and this is why there's been all this talk about if Nippon Steel will acquire them, because their earnings ability has been severely affected here. And to look at it on a cash flow basis, they went from generating $4 billion in cash to barely being able to do $1 billion now. And
Right.
that's just on the operating cash flows. If we look at outflows for capital expenditures, they cannot sustain their own capital investments. And as a
Right.
manufacturer, right, they're capital intensive. They're not like a tech company where they don't have to put as much into their operating assets.
Right.
They're working with physical things, and those tend to be more capital intensive.
So
So-
I was gonna ask a couple things really briefly just before I forget. These little things on the side that says SA analyst, Wall
yeah.
Street, and quant. I've heard this buzzword quant a lot. So that's what do those mean? The rating summary.
So I think they're getting Wall Street analysts and just summarizing what their opinions are. Quant, it's quantitative analysis. What they tend to do is they look at a lot of numerical figures that are statistically predictive of certain price targets within a year.
Right.
So a standard thing for analysts to do is to say, I have a 1 year price target for this stock. It could be higher, it could be lower. I think it's going to be this, and this is why. So Seeking Alpha has developed its own algorithmic quantitative analysis thing
Right.
that does it. So if we click this, it'll show how it's rated U.S. Steel in the past. So over the past year, it's been go to 3 years. There's been sell periods, there's been hold periods, there's been buy periods. So that's basically.
And so, if you were looking at I want to back up for 1 second, and then I want to come right back where we are.
Mhm.
if you're a new investor, let's say you're making 50 to 100 grand a year,
Mhm.
you generally don't know what to do with your cash, but you don't want to get taxed. Basically, like if you're thinking, like I don't want to get taxed on anything that I make at all. So however I can put my excess funds back into stocks, whatever that might be, I don't know the number, but let's just say, what would you say the number one thing that a new investor should be looking at on longevity wise? Should they look at something like a Google, a VOO, and then once they get a kind of basic portfolio in the S&P 500, for example, then they say, let's say that next step when they're like, if they were to look at US still, what would be the way that they would say, okay, like now I've got a okay portfolio. What do I want to like? How would I like if I were like a gambling man and I'm like, okay, I want to look at US Steel and say like, is there any way I can make money on this? I know there's like shorts and options and all this. What would you say to like if just using US Steel as an example, how would you, if you had 500 bucks to say, okay, I can gamble 500 bucks, looking at this portfolio on this stock, what would you say would be like your, you know, estimation of what you might do with it, for
Um,
example?
so I mean, I wouldn't look at it as a gamble. I you mentioned before that, like at the beginning, that um, I'm a stock trader, and technically I have to put in trade orders in order to own even one stock ever in my life. But usually I think the understanding of a stock trader is someone who's just like a merchant, like you're just regularly buying and selling some sort of inventory. And in this case, the inventory is stocks, and is treating the stocks as just pieces of paper. And usually people who fancy themselves traders don't really care about the ownership, and they don't care about the intrinsic value of the business. What I do, the reason why I've looked at the financials is because I basically say it should not feel like a gamble. The financial reality of the business combined with the price that you pay for it, whatever that may be, um, you should only buy if it feels like it's not a gamble. By that I mean, you put yourself, like, run an extreme scenario through your head. If you buy this stock today, and then the SEC says tomorrow, you know what, we have problems in our capital markets, we're going to shut down the stock market for 10 years. All of your stock positions are now private equity holdings, and you're stuck with them. Um, so basically, at that point, the only value they have to you is the earnings they can produce for you as an owner, the same as if you were just buy a hot dog stand from someone. So I just say, if you don't think you're getting a good deal for if that happens, you should not buy the stock ever.
So you would say that the most important thing to look at is the competency and of the team involved and what you expect that they're going to do with what they got, essentially.
Yeah,
Was
so
that what?
the management and how good or bad they are, although sometimes you can get good investments even if the management is dumb, sometimes the product is so good that even incompetent management cannot run that business into the ground. Um,
Looking at this at US Steel, would you say that there's any scenario in which you would buy now or in the next 6 months, based on
um,
what you're saying?
there's a possibility that I would buy them. I would want to see a much lower price. I don't think I'd want to buy them for the current price. But I mean, if we look at like where they were in 2020, right, like single digits, it's difficult for me to imagine. And we think about single digits, what they'd be about a $2 or $3 billion company if the share price went to the single digits. It's difficult for me to imagine that a company, a major steel manufacturer, that can it's getting anywhere from 15 to 20 million in revenue on steel manufacturing, and that when things go well, they can generate like say at least 2 billion in cash, um, that they wouldn't be worth that much. The issue, of course, is when things go badly. I'm guessing they had taken a lot of debt. Yeah, so they took on a lot of debt during COVID, and then even though they had generated a lot of cash, they did not hurry to pay that debt down. So if we look here, what did they do? Well, they repurchased some stock, questionable move. when they have a few billion in debt, and they're a cyclical. Um, so they raised about 4 billion in debt here, um, or wait, no, they raised about here. They raised about 4 billion here. They raised a bit more, but they have not been repaying all of it consistently. So, it's basically a question of how much money do they make, and then, do they have a lot of debt or other obligations that are going to eat away at that? But even with the debt that they have, if they went from being like an $8 billion company to a $1 billion company, I would look at that and think, all else being the same, like, it's possible it becomes a $1 billion company because the lights are about to go out. They're on their last legs. They need a miracle, right? But if it's nothing quite that bad, if it's a minor setback, and a minor setback causes, a 90% crash in the stock, even I would have trouble thinking, okay, this stock is too risky. Like, it's, too important of a steel manufacturer. So there are a lot of businesses where, like, think about Walmart. Even if the dumbest person alive became the CEO of Walmart, would you feel it's risky to buy the whole company for $1,000? Write a check for $1,000, give it to the board of directors in Walmart, and they'll give you the keys to the company. But the CEO is going to be the dumbest person alive. Does that feel like a particularly risky investment? I feel like you could salvage that 1,000 and then some, even in that situation. Do you see what I'm saying?
Yeah, definitely, and I appreciate that because it definitely makes a lot of
Like,
sense.
let's just look at, like, Walmart's net worth, right? So we're not even going to look at their earning ability. Let's just look at their net worth. So they are common equity. Here we go. Total common equity. Net worth is $91 billion. All right. So even if you liquidated it for 25 cents on the dollar, if you paid $1,000 for that, you're making one of the best investments anyone's ever made in terms of returns, right? So usually you don't value a company just for liquidation value anymore, because obviously we don't expect Walmart to liquidate. But, like, this is a financial fact, right? Like, let's look at like a big part of their asset value. A big part of their asset value is real estate, right? So that's probably what most of this $263 billion here is. There's net value here. So a lot of this have just depreciated over time. That doesn't mean that they couldn't sell it for more than this number, right? Not very many intangible assets, so not very much goodwill or really any other intangibles. So probably if you wanted to liquidate Walmart, you could probably get a decent amount of money for it. And it's right now it's 780 billion, so it's trading a few multiples of its liquidation value. So obviously people think Walmart has some earning ability in excess of the thing. So Jack, did you pop out for a bit?
Yeah, I just lost connection, but I'm back. I heard what you said.
Okay. Yeah. So I mean, that's basically what it comes down to. And if you just understand the business well enough, you can, not just look at the financials, but you have to be able to make assumptions about the future. So if you understand the way the product works, that market works, or maybe even just that individual business works.
So like with U.S. Steel, for example, like is there anything that you would try to, like, would you think that there's some sort of research that you would do in order to make a prediction on something like that? And you say, like, well, now that Trump's in charge, I expect that there will be more of a market for steel in the United States, but you would kind of look for some sort of data point to point that's a safer bet than it currently is, and the price was reflective of that. Does that make sense?
Mm-hmm. Yeah. I'm trying to look at see if I can find like an index for steel spot prices on here. Certain indexes are a little harder to find sometimes. You got to know exactly how they're coded. But you could look at steel spot prices. You could look at how much steel supply. So one reason why American steel companies have had trouble is because China is inflating the global steel market. Over 2024, they just started exporting a lot more steel, and it's supply and demand. You put out more steel, steel prices go down. And so one reason why Trump's put a tariff on all foreign steel is because he wants to protect domestic steel. One of the biggest uses of steel in this country is the auto industry. And so steel manufacturers, right, like United Steelworkers, are a very powerful group politically. And you might notice they had implicit support for Trump this time rather than just outright endorsing the Democrats. And so, Trump flipped the Rust Belt state. So he has a political interest in protecting steel. So those are things you can look at just for a company like this. Another one, I actually like to look at this one more. This is Cleveland Cliffs. They also manufacture steel. They were attempting to acquire U.S. Steel, and look, they have a lower market cap. They're $6 billion.
Interesting. So they must, but the fact that they were looking to buy out U.S. Steel also lets you know that there are some people with significant funds behind this company, which is interesting.
They would have been raised. They would have raised capital. They would have probably taken on a loan to do it. And so it's if steel is something that an individual investor feels like they can grasp, then these sorts of companies might be something to follow. I think for every individual investor, they need to figure out what is their circle of competence. What are the things
that what are the things that they have an interest and knowledge about?
Right, because you have to take the financial data, and then you have to be able to understand the story of that company to make sense of it. And if you can't imagine what's going to make a company grow, it's going to be very difficult to know what is a good price or even know how to respond to price movements. So, like a good example is, this is one of the few examples of where I did something that could be characterized as a trade, but this is Root Insurance. They're a small insurance company. They're worth, about $1.6 billion. Share price closed at 100. You see, the stock price has done a lot over the past year. If you look here, just a year ago, it was worth less than $10 a share. So now if you bought a year ago and you put in enough money, you could be a very rich person already.
What company is this? Sorry, I didn't see.
This is Root Insurance. And I first noticed them probably around here. I wrote an article about them on Seeking Alpha. And then Seeking Alpha editors reached out to me and they said, hey, Root's about to have its earnings come out. They reached out probably around here. Would you like to do an article to cover that reviews their earnings after they come out? And I said, sure. And at this point, they hadn't been profitable. You'll notice it shoots straight up from 40 to 68 the next day. Not very many stocks will shoot up that much in a single day. And it has not gone below this amount since it breached it. And that's because here they had not had a profitable quarter. Here they reported their first profitable quarter. So people said, okay, this company can do it. And so I took a position here. I looked at what the earnings were. With a single quarter, I basically said, well, annualized, it comes up to about this much. If they can continue to grow and have this amount of earnings growth, here are some things they should be worth over a long period of time, depending on which growth assumptions you have. And I basically determined that in 10 years, if they just take the earnings and hold it on their balance sheet and build up their assets, because insurance companies typically do that so they can have a reserve against their insurance liabilities.
Right.
If they continue doing that, then they should be worth about 65 a share. So with no earnings growth and just continuing what they did this quarter, in 10 years, they should be worth 68 a share. And if they have earnings growth of 10%, they should be worth about like I want to say like 106. And then if they have 20% earnings growth, they should be worth more than that. And so I bought here. I held through all this, and then as on Wednesday, fourth quarter earnings will be announced for this company. And in the lead up to this, the price started going up. It got up to about 138, and the next day it started to go down. And sometime on the 14th, before it got to 129, I sold it about 135. So I bought a bunch at 68. I sold it about 135. It was a near double. And that was the closest thing to like a trade that I would normally do.
Right.
but it was informed based on what I thought. I said, okay, this is what the stock should be if they just keep doing what they're doing now. And I
So
basically said,
that's the
okay,
hype. So you're saying like this is hype, and then it's going to have some sort of correction, and so you took your chances, you sold out, and then if you see
I
things come back closer to the
well,
normal,
I didn't know that it would have a correction. For all I knew, it could continue to go to 200 based on hype. But I knew that based on what the business was worth, that this was in the very high range of earnings possibilities. And,
right? Got it.
It's basically saying they're probably going to be growing their earnings at an average rate of 20% a year over the next decade. And maybe they can do that. It's certainly easier for a small company to do that than a big one.
Right.
But the thing is, what foils that is one bad year. And here's the thing too: is I'm getting that price today for something that is essentially pricing distant future events. Why not just take the value today and then see if I can get a better offer? Now, as you can see, I guess some people started to feel the same way as well because it closed at a little over 100 today. So that's an extra 30%, right? That was on the table. And I just went ahead and took it. And of course I got in at 68, so it was more, but like if I'd held, I'd still be up, but that's
Yeah, but you basically doubled your money, or not double, but you know what I mean.
Yeah. And
so just really quick, just really briefly, I just want to ask a couple questions because I noticed that on the side over here it says, you guys are saying hold, Wall Street says buy, and Quant says strong buy, and I think that's very interesting. And I'm sure there's reasons behind that, but I guess first of all, what kind of insurance does this company sell?
It's mostly property casualty automobile insurance. And what allowed them to grow is they have a pretty low cost distributor network. They basically are an online insurance company. Like they've do a lot of their insurance sales through Carvana. And so as Carvana grew, they grew since they
right.
They have easy access, so it's not expensive sales and marketing. They don't have a lot of, usually one of the biggest expenses for insurance companies is commissions to the insurance agents.
Right.
And so because they don't have a lot of those commissions, they can compete well on price while still having, still not pricing for very expensive or risky insurance policies. Because the riskiest thing for your portfolio of whatever type of insurance you have is that the premiums you charge will be insufficient to cover whatever a normal set of claims would be. Right. With automobiles, it's very unlikely you would have some sort of black swan thing where everybody has a claim at the same day. With homeowners insurance, that can happen, right? If you do homeowners insurance in Florida, you're going to have a black swan moment every 3 to 5 years probably. And there are some companies where pretty much all their insurance was homeowners policies in Florida. And I'll just give you an example. It was like I remember now. Heritage. So they went public about a decade ago. This is where they were. This is what happens after this is I think when around Hurricane Ian happens, they start to go down. There was storm season was pretty bad too. Hurricane Ian was 2022. There was a storm season in 2020 and 2018. I remember. This strange their balance sheet. 2022. We look here. It goes down even further. Look at how low it got here. And so it went from being 20 a share to $1 a share. Let's look at the balance sheet real quick here. Their assets. If we look at total assets, they did grow, but if we look at their liabilities, they grew even faster. Right. It's
right.
And if we look at
the margin just got squeezed out essentially.
Yeah. If we look at their equity, right, their equity went from, peaking around here to, getting crushed. And it became less and less likely that they would be able to cover their insurance liabilities, right? And so, if you know something about insurance, you could see why something like this is risky. And if you know something about Floridian insurance, you might know when the situation's about to improve. So around the summertime, the Florida Insurance Commissioner started allowing insurance companies to price better. And then they also, in 2024, cracked down more on frivolous lawsuits that were being filed against insurance for my roof got damaged. This is a $50,000 roof job kind of thing.
Right. There's a lot of fraud that goes on for
Yeah.
sure
So
on all sides for sure in
yeah, and
insurance.
so things like this can change it. So there's different things that affect what the risk is, and you can use that to analyze things, and
Got it.
determine whether or not you would want to get in today, here, well then, or here, or here, or here, or here, or right. It's going to
Right.
be based on how you
And
understand those facts.
and definitely like if there's reports that these companies are putting out and you could get access to them or access to people like yourself who do go and read these and then give you a summary based on this. And of course now with AI, I'm sure they have, that's what that you guys are doing with this
Yeah,
with this company. But you basically take these reports and make it digestible essentially.
yeah. And last year in January, so January 18th, 2024, I wrote an article on Heritage,
Okay.
and I basically said it doesn't make sense. I would say so. I wrote a sell article. That's up 73% since then, even more at this point here, right? So it's a 73% as of this moment. And I basically said, long term, the risks are too great. Florida is basically a middle finger that sticks out the Atlantic, and hurricanes hit it, from east, west, and south. Why would you underwrite insurance here? Um, it is true that after I wrote this, um, Florida insurance commissioner allowed price increases on insurance policies there, and at the same time, they began reforming the laws so that frivolous litigation wouldn't hurt them as much. But the
Right.
fundamental thing that hurt this business is that it's in a very risky area. It's in a place where real estate prices are always going up, and there's a lot of storms that just constantly hit it.
Well,
So
and now they're about, but see, and now the news changed even further because they're having a crash on the market. So what is that going to mean? So that's a whole other side that people weren't thinking about. And you and I talked about that offline because you and I both noticed that's going to be a problem 5 years ago when there was a big surge into Florida, right?
yeah,
Now that bubble's popped. How do you think that's going to play into the current evaluation of where it's at now?
well, it'd definitely be better if the property value is lower. The potential liability for an insurance company there
So
is
that'll
lower.
help. So that'll actually end up helping them probably in the long
Yeah,
run. Got it.
it's. I mean, that's the thing about insurance is the risk is the potential upside of your liabilities. It's not just the volume of them, but how much could they theoretically get to claim against you. And property casualty for auto, very, very consistent, very easy to predict, very stable. That's why you have a lot of insurance companies who are profitable in that.
Right.
When you get to homeowners insurance, some states, some insurance markets, because it's always state by state.
Yeah, like
Are
California and Florida are
yes,
terrible right now. Yeah.
California, Florida, New York, because the property values are high and tend to increase. People, want to pay more, so that increases the potential
So,
liability. The insurance commissioners are usually very stingy, and then Florida and California both have a lot of natural disasters.
so,
In Florida, it's the
so,
hurricanes. In California, it's the fires.
so looking at this one, would you say that you made a mistake per se, or would you say that in the long run it was just it was just too much risk to?
It's too much risk. You don't have to buy every stock. There's thousands of stocks. You don't have to
Right.
buy all of them. And there are some people who got angry in the comments and said, like, how could you say this is a sell? They're improving things in Florida. Brr, 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 brr. But the point is, if you sell, take your money. How much money did you lose?
Right.
Right? You still have the money. If you buy something and then,
Yeah, like if you're like basically what you're saying is like if you're a gambler, go ahead and gamble. But if you're playing conservative like me, then maybe that's not the best bet, right?
What if because I wrote this in January, what if 3 Category 5 hurricanes swept across Florida after I wrote this? Would the stock have done this? No. And here, you see, this is what happened right after the hurricanes hit, right? So notice how people felt at that point. So it's not for nothing that I felt that way. It is less risky just because for the reasons I mentioned, but like, why even bother in the first place? You can invest in insurance companies that don't have this kind of potential. And of course, here I said, here's an insurance company that doesn't have this risk potential. Here's what I wrote, right? I wrote buy at 71. I managed to get 68 on it. All right, but that's pretty close
Right.
to what I got here. So I said it was hold here, right? I was not yet sure. In August, I was not yet sure.
Right.
And even though it was higher, I said it was buy. So was the hold a mistake? Well, I'm working with different information here, but here they prove that they can make a profitable model.
Right.
Even though I don't get as good of an entry price, I'm basically saying, okay, they can do it. If we continue with the growth assumptions that led them to profitability,
It's
how
just a
much can
safer
these
bet that
products
they're not
get?
going to collapse. Essentially, like
Yeah.
you're basically looking like the worst case scenario, they may go down by $3 because they're actually worth 68 for
Right.
sure.
So
Right.
we're coming up on an hour here, and we're going to be closing down where I am currently. So just to sort of like, if there's a common thread with all of these, right? I look at their ability to make money or lose money, and what you as an owner in the business would risk if you have a position in that. And there's a right price and a wrong price for those different possibilities. And we can talk more in the future about ways we evaluate that. But that's sort of like how I look at it. And the whole historically, it was at 200, buy again if it goes below 200. That really shouldn't matter. What really should matter is, what do I think is the financial future of this business, and what do I think is a good price for that? And there could be different reasons the stock goes down below 200 again for a certain company. It could be because COVID happened and everything's being sold off. It could be because something really bad happened to that company and it's just not worth what it was anymore because it will not make the same amount of money anymore. And if you understand the business, you can sort that out for yourself. So that's basically what it is. And I would say somebody who works in the Florida insurance market and has a very keen understanding of how that works might know the exact right moments to be invested in a company like Heritage. But that's not going to be most people. But
Right.
just because most people might say, oh, this is risky. They write around here, oh, it's a sell. That doesn't mean they can't find something else and just not risk their capital. The idea is find companies you understand well, where when you make the decision to buy, it's not a gamble. It's essentially a no-risk investment for you.
Yeah, that makes a lot of sense to me. And this is like a very extremely informative experience for me. And I mean, I had a lot of examples I wanted to dive into, but I think this is a good first delving into it because it gives me a good sense of where to start at as far as comprehending this because I've looked for this kind of comprehension for a long time and
appreciate that. I want to answer this person's question real quick. Generally, you can't invest before IPO because it's not public yet. So you would need to be some sort of inside investor that could do that. So if you start your own business, you can invest in it before the IPO, but then you would have to take it upon yourself to do the IPO. So just wanted to mention that. But yeah, glad this worked for you. I imagine it's kind of an information jam too, even for people who are otherwise pretty intelligent and follow along. So I also want to see how people who follow your channel, what they think of it and what things they might want to ask or what
yeah,
follow
absolutely.
might have.
Yeah.
So we can always address those in a later episode. Like questions like this, we can always address later. But yeah, I got to wrap up now.
Yeah, absolutely. Thank you, Joe. We'll talk soon. Have a great day.
Thank you.